Good day, fellow investors. I really enjoyed researching Bill Ackman's portfolio. There might be not a spectacular buy, but there are these small things that compound and give him really an investment edge that we can also take advantage of. Of course, his edge did really well for him over the last 20 years, and he has significantly outperformed the S&P 500 over those 20 years. Let's dig into his portfolio positions stock by stock. We'll also discuss Pershing Square Holding, a stock that you can buy and have him work for you. And the very special thing is that the net asset value is around 50, while the stock price is trading at a 45% discount at 33.60. Of course, this is trading at the Amsterdam Stock Exchange, so you need an international broker if you want to purchase this and have Bill work for you. And if you click on the link in the description below, you support the channel, and you might want to check Interactive Brokers, which is an international broker that gives you access to most global markets. Now, let's quickly start with his strategy. 2 weeks ago, we shared Bill Ackman's interview to the Interactive Investor, where he discussed what's his best stock to buy, Pershing, as we just discussed, and I'll put the link in the description below to this video, but his strategy is summarized in the following. He looks for predictable businesses where, with a high degree of certainty and confidence, you can estimate that the business will be there for a very long period of time. This consequently also means that you can predict cash flows, growing cash flows, many years forward and build them up. Further, of course, if you are looking for such a business, you need a business that has a strong business position, thus a moat, and can withstand the test of time. On portfolio, he has a high concentration strategy, currently 7 stocks and the hedges. And as he says, this is a high return strategy and we can afford to lose, thus we can afford to make mistakes. And then a part that we cannot really do, but maybe we can learn and develop over time, is the sophisticated asymmetric macro instruments, the hedges. So we are spending a lot more time looking at interesting asymmetric macro type instruments, and that has been a very profitable place for us. That has been very profitable for Bill Ackman over the last years. But the 3 key factors from the stock research I did over the last weeks is that all his 7 holdings do huge buybacks, and he is also buying back Pershing Square stock, his own stock. The businesses offer, because of the quality, inflation protection, thus follow the line that Warren Buffett said, buy the best business in the sector, that's the best inflation protection, and those have great positions. But something very important, he is not really thinking at a price now from an absolute perspective. He has trimmed most of his positions, made his money, but he still holds them despite the fact that price is 2x. He sold Starbucks, Domino's, etc., but he still holds these core portfolios. So let's start looking into stock by stock of the portfolio. So if we look at Bill Ackman's portfolio, the top position is Lowe's, 25% of the portfolio, followed by Chipotle, almost 20%. Restaurants, Brand International, Tim Hortons and Burger King, also big position. Hilton Worldwide Holdings, 16%. Howard Hughes, he closed Domino's Pizza, small position in Canadian Pacific Railway, and he opened a position recently in Universal Music Group. And we can immediately start with Lowe, and you can see here that he bought during those pandemic March lows, he closed his hedge position and then bought a lot of stock, 4 million, but he has been significantly trimming down the position as it doubled or tripled, sold 2 million stocks, thus he got his money out, but he still holds a significant part of it as it is the largest position in his portfolio. And for those that don't know what Lowe does, if you're not from the States or Canada, it has home improvement stores, 2,200 of those. And if we look at Lowe's outlook, they worked on home appreciation trends, aging housing, you have to rebuild, remodel your house, healthy consumer balance sheets, and mortgage rates near all-time lows. These things don't really work anymore as interest rates went up, but Lowe is still doing well, the market is still liking it, and the stock has also rebounded significantly over the last week. And if we look at what Seeking Alpha has to say, with Lowe, if we look at the earnings estimates, by the way, if you want a 60% discount on Seeking Alpha Premium, click my link in the description below. Consensus estimates are for huge earnings growth ahead, and this will lead into what Bill Ackman is also investing in. 13 and then over the next 10 years, almost triple in earnings. And that triple will come from buybacks. They intend to spend 40 billion over the next 3 years to push further those buybacks and the stock higher. And the thing is that they are spending much more than they make on buybacks, thus taking on debt. But if you look at revenue per share, everything per share is growing. Revenues went up almost 2 times over the last years, but thanks to buybacks, revenue per share went up 3 times. So it's really working, but we must also take into account the total liabilities went also up 3 times and also long-term debt. So they are leveraging significantly the balance sheet to push the stock price higher. And we recently discussed how Mark Cuban said how buybacks are everything wrong with corporations today. And you might want to check that video in the description below because it will really give you a different perspective on how buybacks work. And the company is taking debt to financially engineer higher stock prices. When it comes to financial engineering, where you delay the costs, issue debt, and take the benefits immediately, buybacks, my feeling is that it is a strategy that works until it doesn't. And only Mark Cuban has voiced that concerns out. And then if you look at when Bill Ackman bought the significant position, give them a little bit of time, and then they started significantly pushing on those buybacks higher, despite Bill selling half of his position when those buybacks really got into traction. So Lowe has what Bill Ackman seeks: profitable business, positive secular long-term trend. They've been around for more than 100 years, so they will likely be around for more. And what might be his influence, financial engineering through buybacks, that builds on that earnings growth. However, they are spending much more than they are making in cash flows on those buybacks, and if they, because of a slowdown or whatever, return to cash flows pre-pandemic, then the current market capitalization would look very ugly, because they don't have the 14 billion promised per year to make buybacks. They need to take debt, and when these financial engineering things start to revert, then it gets ugly. So it is risky from an in retail investor perspective, but you never know with Bill. He might be hedged on this, on the economy, on housing, so it could be a win-win-win situation for him, which is something that's very difficult to do for retail investors. The next stock is Chipotle Mexican Grill. And then again, he has been mostly selling his position since opening when the company had that sanitary issues. Again, trimming, but it is still a large part of his portfolio, 21%. If you look at the company, he says how everything is growing, continues with its great performance, lead the industry for same-store sales and everything, great economic models with high margins, and he believes that the company is positioned for the current inflationary world because of the low cost inputs and good market position. But if you check his actions, he has been trimming earlier, and now after the pandemic he is just holding his built position, but he has also already made his money. And if I look at the valuations there, price to free cash flow is around 30. So yes, great business, growing, everything there, good margins and everything. But still, for me, the price to free cash flow of 30 means that it is, let's say, fairly priced for such a growth company. That's again medium risk, medium reward. But then this is Bill Ackman, so he is pushing them to do buybacks. If we look at the 900 billion spent over the last 12 months to do buybacks, that's not a crazy buyback yield, but it is in line with what Bill Ackman is doing. Same situation as Low. He made his money already, sold quite a bit, and very likely that is heavily hedged for the sector, for this or for that, so that this with the buybacks makes this a win-win for him, because his goal is to increase net asset value so that he can get a higher fee. Next stock, Restaurants Brands International. We discussed this already a few months ago, and the business was fairly priced. P ratio, price to free cash flow, of around 10-15, now a little bit higher as the stock has rebounded. And if we go to Bill Ackman's summary, so high margin because it is a royalty business, thus it also benefits from inflation. They are executing on the back to basics plan, growing at an attractive rate, and they believe it trades at a discount to peers and intrinsic value. Why it is an inflation beater? Because they get royalties. So if your operator has to increase the price of Burger King and Tim Hortons and everything, they get a higher fee on that, and the margin is of the operator is lower or stable. They just increase their royalties. So that's a business model. When it comes to valuation, 3% dividend yield, 4% buybacks, stable cash flows, plus if the growth is linear over the years, which is unlikely for such restaurants, then yes, then the return will be 12%. But if the growth isn't linear, then it will be a little bit lower, in line with the sector and the industry. Again, nothing wrong with Chipotle, great business likely, fits Bill Ackman's, they're doing buybacks, but he sold already, he made his money, and perhaps like Buffett, he's now just holding on to these positions. The next company is Hilton, another royalty company. They even increased their position during the pandemic, and they expect Hilton to continue to deliver accelerated earnings growth for the foreseeable future. And if we check again Seeking Alpha and the earnings estimates, earnings are expected to double over the coming few years. And if this will be the case, then also the stock will likely follow. So the core here is the earnings growth, the earnings double, earnings per share, and also the capacity of the hotel royalties to just get a higher share of likely increased revenues on those costs. In my opinion, again, a fairly priced, good quality, long-term business. The next business is very intriguing, Howard Hughes Corporation, and that was also a stock that he presented at the 2017 SON Investment Conference as a great investment, and his summary now is that they own these master planned communities. That is an advantage compared to other similar businesses because it maximizes the value of the portfolio. Located in low cost of living, low tax states like Texas and Nevada, more people are coming there. Good insulated balance sheet from rising interest rates, and we believe the company is extremely well positioned for the current inflationary environment. However, there is significant debt there. Now they have started buying back their shares. But if we look at the stock price, if we look at when Bill recommended the purchase, those who followed him are now 50% in the red. And this also shows how much patience you need. So Bill Ackman bought his first stake here. He made his money on the first purchase, but on the other purchases that he made, now, as he of course bought likely during the pandemic lows, so he is there on a good return as 37, now we are 50, 60. So yes, he bought more here, thus that's a negative. And depending on when he bought here, that's also not a negative return. But he has been around the stock for the last decade, and it hasn't done really much, especially not compared. Will the value unlock? That's a good question. You have to see how owning those properties with the structure, with the debt that is there, with the potential growth, etc. For me, especially as it didn't develop as Bill thought over the last 10 years, once something doesn't happen when you expect it, it becomes riskier and riskier that it actually does not happen. However, it is trading at book value, but then again, you must see these properties are valued on interest rates, cap rates, so you have to also lower the book value if it doesn't work. And if the book value goes lower, the debt stays there, which is then again a risk. The next company is Universal Music Group. That is the most recent addition to his portfolio. And I've looked a little bit. His summary is that it is, of course, a great royalty business, growing at an annual rate of 10%, high teen growth constantly, and the current valuation represents a significant discount to intrinsic value. Now, if I look at the valuation, this is from last year's free cash flows around 600 million, not even that much, but for the market cap, significantly. So I'm thinking here that this might be a Bill Ackman ego thing, that he had to drop his SPAC deal because of regulatory SEC investigations or something, and then he went another route, but he bought the stake that he promised to buy there. And if we look at the Universal Music Group stock, it is down since it went public a year ago, but still not that much down. However, if I look at the market cap of 37 billion compared to the 700 million in free cash flows and the P ratio of 55, okay, there is a dividend yield, but there is a lot of growth that needs to happen for this to become a profitable long-term investment. Bill Ackman believes in them, but we will see over time how this develops. It is a growth story, and Bill Ackman wants these long-term growth royalty businesses that will likely do well over the very long term. Now, the best buy that Bill Ackman says is Pershing Square. Let me explain why there is a discount. It's not that the market is stupid. Of course, if you want to buy it, you can buy it on Euronext, London Stock Exchange, and I think there is American depository receipts on the New York Stock Exchange, but you have to see what and how fits you. Bill Ackman is big on the discount. Even in his last letter and financial statement discusses how Pershing Square Holdings has the biggest discount to net asset value, and then he compares it with Scottish Mortgage that has only a 6% discount. Well, let me show you why Bill Ackman has such a discount. So Bill Ackman's market cap is around 7 billion now, and look at this. From the 7 billion market cap, the 2021 performance fee was 462 billion. The 2020 was 692, sorry, million and million. So huge performance fee. 10% of the market cap can easily go for his performance fees. And therefore, if you go investing, let's say 100,000 for the long term with Bill Ackman, you don't earn any money, you do it for 10 years, and let's say that he does a 10% return. Given that there is a 20% performance fee, Thus, the 10% that he makes for you becomes 8%, and there is a 1.5 management fee, whatever the performance is, so the 10% becomes 6.5 for you. Thus, we put in interest rate variance 3.5, calculate this, and then you can see here how the future value at 10% is 259,000, at 6.5 is 187,000. This is a 30% discount, which then explains also the net asset value discount for long-term investors. So yes, there is a discount, but that is a static view. There is a discount now. If you look at the future cash flows that you can get or what he is doing, then you see, okay, for long-term investors, whatever the businesses do, we will lose 35% if the performance is there. Even if there isn't the performance, you will lose your investment over the long term from the hefty fees. Of course, Bill Ackman deserves those fees because of his great performance in the past, the hedges, the this, and likely something that will remain his edge over time, but it is still a cost, and the market is therefore discounting him. Just a note here, Bailey Guilford, that's managing this Scottish Mortgage Trust, has a total fee of 0.3% compared to the 1.5 and 20% performance fee from Bill Ackman. That is a huge difference. So I think that Bill's edge is that he can push those companies to do buybacks and push on those buybacks to keep the stock prices higher, to keep his net asset value higher, to get those hefty fees. That's something. He is great with the hedges, and he likes to select these businesses that have high margins, high cash flows, long-term runways. So he is an investor amid that financial engineering that he is doing. I'm a bit disappointed because I hope to find, okay, an amazing buy. Let's put all our money there. There isn't such a buy at the moment, and that's also the reason why Bill Ackman is so heavy on those hedges to give protection to his investors. So also something to consider, maybe just having Pershing, because Pershing is long great businesses at a fair price, not a great price, but you have the discount, and then you have also Bill Ackman hedged that in case of crashes, he will likely balance out those crashes. So that's also something to think about when it comes to investing. My personal takeaway is I have to work more on those hedges. I won't make any promises, but that's it. Follow, and then if you are pleasantly surprised in the future on that, great. Thanks for watching, check the interview, and I'll see you in the next video.